What if you were told that the global economy is sitting on a $500 trillion time bomb that could explode with rising interest rates? Interest rates are the cost of borrowing money, or on the flip side, the reward you get for saving. They play a crucial role in our economy, influencing the decisions of consumers, businesses, and governments. A change in interest rates can ripple across the entire global economy, affecting everything from small personal loans to the price of the house on your street and the returns on your retirement savings. Now consider the current financial landscape. The Federal Reserve, the central bank of the United States, is engaged in a battle against inflation. To do this, it's considering raising interest rates, a move that would make borrowing more expensive and saving more lucrative, in theory, cooling down the economy. Meanwhile, big hedge funds and banks are making bold moves of their own. They're betting against the bond market. This essentially means they're speculating that interest rates will rise and bond prices will fall. But they're not just playing with their own money. They're using financial instruments called derivatives and adding a dose of leverage to amplify their bets. Derivatives are contracts between two or more parties based upon an underlying financial asset, like a bond. They can be used to hedge risk or for speculative purposes. Leverage, on the other hand, is the use of borrowed money to increase the potential return of an investment. But with great potential returns come great risks. The combination of derivatives and leverage could create a precarious situation. If interest rates don't go the way these big players anticipate, they could find themselves in a world of financial hurt. The losses could be so large and widespread that they could ripple through the entire financial system. These economic maneuvers could backfire, leading to what some financial enthusiasts term as a black swan event. But what exactly is this black swan? In financial terms, a black swan refers to an unpredictable event that is beyond what is normally expected of a situation and has potentially severe consequences. Now, you might be wondering, what does this bird analogy have to do with finance? Well, a black swan event is a metaphor that describes an event that comes as a surprise, has a major effect, and is often inappropriately rationalized after the fact with the benefit of hindsight. Let's break this down a bit. Picture a tranquil lake, with all the swans gracefully gliding across the surface. They're all white, as we've come to expect. But then, out of nowhere, a black swan appears. It's unexpected, it's different, and it changes the way we perceive things. That's what a black swan event does to the financial market. It's an anomaly, something that goes against what we understand and expect, and it can have a significant impact. Now imagine our current economic scenario. Interest rates are rising, and this is like the calm before the storm. Big players like hedge funds and banks are taking a gamble. They're betting against the bond market. But here's the catch. They're not just placing their bets, they're using leverage and derivatives to up the stakes. The potential risk of this is enormous. If their bet goes wrong, the fallout could be catastrophic. And given the unpredictability and complexity of the financial market, this could very well be the black swan event that we never saw coming. This situation is akin to sitting on a $500 trillion time bomb. The higher the interest rates go, the closer we inch to detonation. And when it does explode, the repercussions will be felt globally, echoing through every sector of the economy. So, with the possibility of a black swan event looming, how does this affect individual investors and the larger economy? Well, we'll delve into that in the next scene. Stay tuned as we navigate these choppy financial waters together. As interest rates rise, the cost of borrowing also increases. This can have a significant impact on individual investors. Imagine you're an individual investor. You've got your money in stocks, bonds, and maybe some real estate, trying to grow your wealth and secure your financial future. But then interest rates start to rise. What does that mean for you? Firstly, let's talk about borrowing costs. As interest rates go up, it becomes more expensive to borrow money. This applies to everyone, from governments and corporations down to individual investors like you and me. If you have a variable rate mortgage or other loans, you may see your monthly payments increase. This can put a strain on your budget, leaving less money for investing or even meeting everyday expenses. But it's not just about the money you owe. Rising interest rates can also impact the value of your investments. For example, when interest rates go up, bond prices typically go down. This is because new bonds being issued will have higher interest rates, making existing bonds with lower rates less attractive. So if you hold bonds in your investment portfolio, their value could decrease. And what about stocks? Well, higher interest rates can make it more expensive for companies to borrow money, which can lead to lower profits. And lower profits usually mean lower stock prices. So if you're invested in stocks, you could see the value of your portfolio decrease. Now, it's important to remember that these are potential impacts. The actual effect on your investments will depend on various factors, including the overall economic environment, the specific investments you hold, and how quickly and significantly interest rates rise. But the key takeaway here is this: rising interest rates can increase the cost of borrowing and potentially decrease the value of your investments. This is why, as an individual investor, it's crucial to keep an eye on interest rates and understand how they can impact your financial situation. While individual investors might face increased borrowing costs, the larger economy could also experience significant shifts. Rising interest rates have a ripple effect on the larger economy, influencing everything from consumer spending to business investments. At the heart of our economic cycle is the cost of borrowing money, also known as interest rates. When rates rise, borrowing becomes more expensive, which can have a profound impact on the spending habits of both consumers and businesses. Let's take a closer look at how this works. In the realm of consumer spending, higher interest rates can mean higher costs for anything bought on credit, from homes and cars to everyday items. This can lead consumers to cut back on their spending. For example, if mortgage rates go up, people might be less inclined to buy new homes. And if they're spending less on big-ticket items, they're also likely to spend less on smaller items as well. It's a domino effect that can lead to a slowdown in the consumer-driven sectors of the economy. For businesses, the impact of rising interest rates can be equally significant. When borrowing becomes more expensive, businesses might scale back their investments in new projects, equipment, or personnel. This can slow down business growth and, in turn, economic growth. Furthermore, businesses that rely heavily on credit to operate, such as those in the retail or restaurant industry, may find it more difficult to stay profitable, leading to potential closures and job losses. Higher interest rates can also have an impact on the stock market. As borrowing costs rise, company profits can take a hit, which can lead to lower stock prices. This, in turn, can affect the wealth of individuals and institutions that have invested in the stock market, potentially leading to further reductions in spending and investment. On a macroeconomic level, rising interest rates can slow economic growth. When consumers and businesses cut back on spending, demand for goods and services falls. This can lead to lower business profits, job losses, and a slowdown in the economy. In the worst-case scenario, it can even lead to a recession. In summary, rising interest rates can have far-reaching effects on the larger economy, affecting everything from consumer spending to business investments, stock market performance, and overall economic growth. Now that we understand the potential impacts, the question is, can we prepare for such an event? While black swan events are by nature unpredictable, there are steps investors and economies can take to mitigate potential risks. As we delve into the realm of financial preparedness, one crucial strategy that comes to mind is diversification. Diversification is not just about having a variety of investments. It's about having different types of investments that react differently to the same economic event. By spreading your investments across various financial instruments, sectors, and geographies, you can buffer against the impact of any single event, including a potential black swan. Now, maintaining a healthy balance of debt and equity is another important step. Too much debt can leave you vulnerable to interest rate hikes, while a lack of equity may limit your ability to absorb losses. It's like a tightrope walk, balancing your liabilities with your assets. It's an act that requires constant attention and adjustment. But what does it mean to stay informed about global economic trends? Well, it's about understanding the interconnectedness of world economies and how ripple effects can cross oceans. It's about staying updated with economic indicators, policy changes, and market trends. It means being aware of the potential triggers for a black swan event and adjusting your strategies accordingly. Additionally, having a cash reserve can provide a safety net during turbulent times. This reserve can help you weather the storm without having to liquidate your investments at a loss. Think of it as your financial umbrella, ready to protect you when it starts to rain. Lastly, consider seeking professional advice. Financial advisors can provide valuable insights and strategies tailored to your financial situation and goals. They can help you understand the potential impacts of a black swan event on your portfolio and guide you in making informed decisions. Therefore, while rising interest rates and the potential for a black swan event may seem daunting, with careful preparation and informed decision-making, it's possible to navigate these uncertain economic times.